Will the Japanese yen, hitting its weakest level in 39.5 years against the dollar today, trigger a historic government intervention? Or will a blowout U.S. jobs report push it even further to the brink?
Hello everyone, welcome back to AI Market News. That shocking number, 39.5 years, is exactly what's setting the stage for all of us today. We're looking at a fascinating market environment where massive momentum in the US tech sector is colliding head-on with historic currency weakness over in Japan. In this explainer, we're breaking down exactly how a surge in US AI stocks is directly impacting Japanese equities and why the macro picture for the yen is rapidly approaching a critical breaking point this week.
Let's dive right into our first section, US tech surge, AI cost cuts. This is the first major catalyst driving global markets right now, based on available data from the overnight US session. As you can clearly see in the chart here, the Nasdaq surged 1.52%, closing at 26,213. This rally was heavily concentrated, really driven by a massive 2.55% jump in the information technology sector alone. So what's the underlying reason for this tech rally? It really comes down to some significant breakthroughs in AI infrastructure. According to current market information, OpenAI has found a way to dramatically reduce the cost of its reasoning models. Now, for those newer to the space, AI inference costs simply refer to the raw computing power required to generate answers. When these operations become cheaper, software companies enjoy much higher profit margins, and they can scale up their products a whole lot faster. Naturally, this signals a massive increase in future demand across the entire semiconductor and hardware supply chain.
Looking at the broader market, the graph shows the S&P 500 following suit, gaining 0.79% to reach 7,499. This equities rally was further supported by a highly constructive labor market picture. The U.S. JOLTS job openings data came in well above expectations at 7.594 million, which shows all of us that the underlying U.S. economy remains incredibly resilient.
Moving on to our next section, Japan's reaction, BOJ Tankan and the Nikkei. Let's analyze how this U.S. tech momentum, combined with fresh domestic data, directly impacted Japanese equities during the Tokyo session.
Right before the Tokyo Open, we received a major upside surprise from the Bank of Japan's June Tankan survey. The large manufacturer business conditions index hit plus 22, which completely crushed the consensus forecast of plus 16. To put that into perspective, this is the highest level we've seen since March of 2018. The core driver here? Massive AI-related capital expenditure. In simple terms, capital expenditure means companies are heavily investing their cash into new physical assets and equipment so they can grow. Japanese companies across the electronics and semiconductor materials sectors are seeing their order books fill up rapidly, and they're spending aggressively right now to meet that future demand.
Now notice the sharp movement on the Nikkei chart here. It initially surged as much as 1,900 points in the early going, reacting very positively to that stellar Tankan data and the overnight US tech rally. However, we saw it pull back pretty sharply mid-session to close up just 412 points, or 0.59%. The main reason for this pullback was a sudden bout of volatility in the Korean equity market. When a neighboring regional market drops suddenly, institutional investors often decide to quickly lock in the profits they've made that day, which leads to a rapid, temporary sell-off. Let's shift our focus to the next section, USDJPY intervention territory. This is the massive macroeconomic currency story all of us are watching so closely this week, and it's casting a long shadow over both equity and bond markets. Tracking the currency pair, as you can see in the chart, USDJPY touched 162.84 today. This marks a fresh 52-week high, and it's officially the weakest level the yen has seen since December 1986. We are definitely no longer simply testing resistance levels. We have crossed the line into full-blown intervention territory. For those newer to currency markets, when a nation's currency depreciates this rapidly, it makes importing essential goods like energy and food incredibly expensive, and that really hurts the domestic economy. To prevent this from spiraling, the Ministry of Finance will often step in and use its massive foreign reserves to aggressively buy the yen on the open market, forcing its value back up to stabilize prices. With one-sided positioning building up so heavily against the yen right now, that intervention risk is currently at its absolute peak. And that brings us to our final section, the catalyst, non-farm payrolls. This is the primary data point that could dictate whether that government intervention actually happens or if the dollar breaks out even further. Based on available data, Treasury Secretary Bessent delivered a highly unusual and clear signal to reporters early in the morning, stating he expects a very strong June jobs report. Because of this, markets instantly began positioning for a blowout non-farm payrolls number. Let's look at the two scenarios all of us need to be prepared for on Thursday. In the bull case, if the non-farm payrolls report beats last month's 172,000, interest rates in the U.S. will likely stay higher for longer under Fed Chair Warsh just to keep the economy from overheating. Because U.S. interest rates offer much higher returns than Japanese rates, this yield gap naturally pulls global investment money straight toward the dollar, which could easily drive USDJPY to target 163. On the flip side, looking at the bear case, if the jobs report disappoints, the sudden unwinding of all those bets against the yen could trigger a violent 2 to 3 yen downward correction in a single trading session. Before we wrap up, let's review the economic calendar for the upcoming key indicators. On Thursday, July 2nd at 8:30 a.m. Eastern Time, we get that pivotal U.S. June jobs report. We also have Fed Chair Warsh scheduled to speak that morning, which will undoubtedly set the tone ahead of the data. Keep in mind that on Friday, July 3rd, U.S. markets will be closed for the Independence Day substitute holiday. Position sizing matters more than ever heading into a long holiday weekend, especially when currency intervention could literally happen at any moment. The ultimate question heading into this holiday weekend is this: will the U.S. labor market break the yen, or will Japan strike back first? Keep a close eye on those charts. Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.